Welcome to TheNBI.com. This is John. This report is for the 3rd. Well, the continuation happened as we had that breakdown of NBI Magenta, well, and below 25 no less, and that acceleration with the NBI White from a daily. We had also seen the DOC spread with the cyan overtaking longs, and there just really wasn't any short-term buyer activity. It hasn't been for quite a few days as we were elevating into this little pop and. Um, Getting close to the steel minus 14, so it's below the 13.5. Um, doesn't bode well for supporting, but right now we're down to the 76%, so broke right through and dipped right to the secondary line, which I had here from our ABM, which is the red one. And 44.66 range is the full positive extreme. See a little red histogram positive extreme right there. So the fill back to that, what we've done up to this point is all the way to the beginning of the breakout. So just normal backfill within the range. I know a lot of people are freaking out in crisis mode, but you can see also we're starting to see a beginning of a little bit of the weakness of short fading here in the NBI white. So it's going to really be interesting to see how much more we go with the negative shakeout. We're below the red line, so means the 76 is not safe at this particular stage. It's going to take some buyers, and of course, timing is good because now you have new fund money coming in at the start of the month, and that should be recognized if we get a pop up here of our steel at this particular point. We're going to see this on the 50K charts as well as intraday first. Um, but nothing out of the ordinary, and actually a fill of the positive extremes, healthy from a market standpoint. Of course, a lot of people talk gloom and doom, and of course, we go to the NQ, and that fill a little bit further over took place right there. Its original breakout wasn't quite a red positive extreme. So from a Nasdaq standpoint, it's completely filled at this particular stage, and likewise, looking at those readings, much more negative shakeout. But the big difference is between the S&P and the Nasdaq here. You can see we're dip below to the green line for the green histograms on the extreme. So no requirement that it continues to break down. So it's going to be one of those where it looks like now we flip to whether the Nasdaq is going to be the one that supports the S&P. So it's just been a little bit of a trade-off, and you can see already slight improvement from short-term buyers. So that's the difference. We get a little bit of juxtaposition between the two markets. One elevates the other, and then one draws down the other, and it's evening out at the end of the day. Treasuries taking the appropriate dip. Okay, so everyone's going to be flying into them, so we should see a bounce back to lower yields, but clear indication that nobody now is expecting the Fed to change course given what they've been seeing from oil. Though it was a nice pullback into the oil. We had positive extremes right about there, so that's just about taking out the first portion of it. We have a little bit further to go to fill back into the upper 70 range. But the longer this stays elevated, again, that's just more of a drain on resources and that. And of course, we talked about that oil rise, horrible for the euro and going to be tough for them to maintain. It was already just capturing a bunch of people on the wrong side of the trade of it that caused this ridiculous spike in the first place. But now, as you can see, positive extremes on that completely filled a few days back, and this is just more of a continuation because, again, who wants a euro when we talked about this before where the banks were already reporting record drop in loan volume, and then the ECB the next day raised rates too little too late, and doing that within a negative economic environment is only going to exacerbate itself. So it's going to be interesting to see how they pull out of that, because it's going to take quite a bit of effort, because obviously U.S. is more attractive from a yield standpoint if you're a European at this particular stage. So crazy to be in euro at this particular stage of the game. From a gold standpoint, again, when there's market selling and weakness, usually gold also takes a slight hit to it. But the reality is, if oil remains where it is, there's going to have to be a significant spike back up in gold. Zero activity from a crypto on all of this move. It's just pretty much dead in the water. Likewise here, from a ETH standpoint, just turning into like a boring, normalized class because it's lost the nuance and the excitement. Now it's just legitimate holders and not really anyone else to shake out because they haven't pumped it up and brought anyone new in from it. From a 50K standpoint, we started to see the breakdown with the lower highs. And then once the weight spike started taking place from a MBI reading standpoint, cascade lower. All pretty clean from that standpoint. Intraday, even easier. So we had the pre-market was nice little pump up. And then as soon as we got to the actual US pre-open bell, boom, selling started, did not stop at all. And that continued all the way through the end of the day. And then in post-market, they tried to get some short covering, brought that back up a little bit. Still wasn't enough to sustain anything. And then later on here, we've already started to see the next wave of sell-off. And it's been bought back up part of the way. So this is going to be the factor. I mean, there's still more of a positive extreme to fill. And once that's done, it'll be interesting to see how much money comes into it, the market versus treasuries from a safety standpoint. And who's going to be looking for a quote-unquote bargain, and whether or not that's sustainable. Of course, we're going to be looking at the economic data that comes through and seeing if it's sustainable. At this point, there's no real crisis on the horizon with that. Things are chugging along. They're not great. They're not extremely horrible. So I think you're going to start to see a little bit more of a mean reversion activity again from the market. And I think that's pretty much normalized. Bias is still to the upside simply because of the inflation and marking that. And then you're going to get the correction within that elevated price structure based on the inflation. So we'll just continue to follow that. And from an intraday standpoint, the trade is fantastic. So easy to follow from that aspect. As always, though, anything relevant, I will pop it on the Skype chat. Trade well.